Let's talk. So now we have to learn how to calculate when we trade. So today's brokers automatically calculate the processes in their applications and provide them to you. Now, when we go to the exchange tab to place a trade, whether it's a buy or a circle, when we set a sell or TP, it will calculate and tell us the price in dollars depending on the size. So as you discussed the lot, what is the lot size? A lot is the standard unit to measure the amount of currency. Being a voter, sold in forex trade, it is measured how much amount of currency we are selling and buying. So one lot is, it contains 100,000 or 1 lakh units. Then the smaller lot is zero point 0.1. It contains 10,000 units, which is a smaller lot. It is 0.01. It contains 1,000 units, which not every broker is providing these days, but some brokers are. We call it a nano lot. It contains only and only 100 units. Now, as we calculated the PIP, how to determine the value of the PIP? So we have to calculate how the lot size affects the PIP and its calculation in dollars. So now you can see in front of you that your PIP value is coming up. Here, for example, number one, we have USD JPY. Its current rate is 119.8. So when we calculated its PIP value came out to be 0.01. So now what will we do with that? We will divide that 0.01 at 119.8. So then whatever answer comes out, we will multiply it. For example, if we are using one standard lot, we will multiply it by 100,000 or 1 lakh units. Similarly, if our size is smaller, for example 0.1 meaning 10,000 units, then we will multiply it by 10,000. So in this example, after multiplying by 100,000 units, we got $8.34 per pip, where our lot size was 1. And if it was less, then it would have been $0.34 per pip. Beep if our lot size were 0.1, meaning 10,000 units. We took the pip value in the second example, USD CHF, the same way. We divided the pip value by the current price. We multiplied it by the current number of units, where we have used one standard lot here, meaning 100,000 units, so its value is coming out to 6.87 per pip. This is a very simple formula to determine which lot size to use. Now you can see here we have used an example of Euro USD. Now Euro USD. Why? We are using an example in it. It's easy to understand because a standard lot of Euro USD is $10, meaning 1 pip on a standard lot of Euro USD equals $10. Similarly, when you go to a mini lot, meaning 0.1, its value becomes $1 per pip. Similarly, when you go lower to 0.1, its value will become $0.1 per pip. Then if you go to nano, it will become $0.01 per pip. So now we have learned in its calculation how to determine the pip value. First, we understood what a pip is. Then we understood how to determine the pip value. After that, we understood how to calculate the value of our lot size and how to calculate the profit or loss per pip. Now let's continue to read this. Let's continue to understand, just as we discussed leverage before, we will discuss it again a little in depth, because leverage in Forex makes our accounts and breaks our accounts. It helps us grow our accounts. It also brings our accounts to zero. So how is this calculated? As I explained to you earlier, if I have a leverage of 100, then if I have $1,000 in my account, I can trade an amount that is 100 times that $1,000. Meaning, if I am trading Euro USD, then I can easily, comfortably, what can I do? I can purchase $100,000, that is one standard lot on Euro USD. Then if I move to USD JPY, because it's one standard lot is equal to $8.3, for example, at the current price time, which we used in the previous example. Today's rate is different, so it's, if I have $1,000, I can approximately purchase 1.2 standard lots. I will be responsible for its profit and loss. Now, another example we have is USD CHF. We bought one standard lot at 1.4530. We crossed 1.4550. Our difference came out to be 20 pips and a profit of 20 pips. As we calculated before, the standard lot pip profit is 6.85. So we will calculate it with 20 pips. If we multiply, we will get a profit of $37.40. So on this spread, if our leverage was 1 to 100, then we would need $387 or a minimum of $1,000 required. For one standard lot is needed. Just as leverage impacts profit, leverage also impacts loss. Because of this, as we discussed, we need to keep a close eye on leverage. Our next topic is spread. What is spread? That spread is the difference between the buying and selling or bid and ask price. As we discussed earlier, it is called the spread. Who provides it? The broker provides it to us. The profit in between is given by the broker. This is why we discussed earlier that the broker benefits from it. Brokers want you to trade as much as possible. In that way, they program their partners, that is, the affiliates, and have them run campaigns. Then they further tell influencers and affiliate partners strategies to trade more and more in shorter time frames, which increases their income. So beta and all office price is also priced on which you can sell the base currency. The ask price at which you can buy the base currency. You discussed the base currency. The base currency is the one that appears on the left side of our computer or mobile screen. The one that comes second is called the quote currency discussed in the previous chapter. The broker's profit is the spread. Now, there are different types of spreads, various kinds of spreads that we use with account types. In each account, it varies differently. Now, we discussed that the difference is called the spread. Now let's take an example of USD. If USD is at 1.1051, which is our bid price, we are getting 1.1051. The ask price we have is 1.1053. The meaning of this is that our difference is 2 pips. The spread we are getting at the moment is 2 pips. Similarly, for example, you look at something with fewer decimal points, like we have USD JPY. Now, if the USD JPY price is 1.10.00 bid price and 1.10.041 ask price, in that our spread is 4 pips. At this time, it was discussed that the yen pairs have their pip at the decimal second point. Numerical defending, how many points are ahead of it? Similarly, our other pairs have 4 decimal points. Then there are 2 types in the spread. One spread is fixed, one spread is variable. Now, what is a fixed spread? It remains the same regardless of the market conditions. Whether the market has low or high liquidity, whether it is market opening or closing time, or the market is in full swing, it does not matter. What matters is that the fixed broker will provide you with the spread they have told you under any conditions. What is the benefit of this to us? The benefit is that our transaction cost remains the same. It increases the same. We know that whatever trade I place, this is the cost I will incur. Now, what is a variable spread? This can increase or decrease depending on market conditions. Now, when participant liquidity in the market is low, meaning during the Asian session or at the end of the New York session, the spread will increase significantly. And when there are many participants in the market, meaning during the New York session or the London session, the spread becomes very low. So, traders should prefer it. Traders who want to trade 24/7 or want to trade in the Asian session or at the end of New York who do not like high volatility should use fixed spot. They want to trade during high trading time in the New York session, meaning during high voltage time. meaning New York session and London session, trading the New York crossover is valuable for them because those spots decrease.